In this video, I'll be showing you a simple breakout trading strategy that can help you profit from huge price movements. So first, what is a breakout actually? A breakout simply refers to when the price of an asset breaks beyond a key support or resistance level, which usually leads to huge price movements. Let me show you an example. So in this chart, we can see that the price is moving within a range. And so we can place a level of resistance above and a level of support below here, as price rejected it multiple times. Now notice, as soon as the price broke out of the key level, the market started trending, and this would have been a good buy entry. Now, the question is, how do we find setups like this where the market can potentially break out? Well, a simple way to do that is by looking for breakout patterns. I'm sure most of you have seen these patterns before. We have the rectangle, pennant, wedge, triangle, all sorts of patterns. Now, a common mistake that traders make when looking at this pattern list is that they're waiting for the market to make the exact same movement as the drawings. For example, they look at the wedge pattern and they'll try to find candles that move exactly the same as this. If you're still doing this, I can guarantee you'll never spot a single pattern. Because the truth is, prices don't move like this in real life. So instead, what you want to focus on is finding the key levels. Let me give you an example. So here, as we look on top of the charts, we can see that the price is forming lower highs, meaning we can draw a downward trend line above it, because again, there are multiple rejections. Next, as we look below the chart, we saw more rejections, and so we draw a support line below here. Now, if you look closely, we actually just found a triangle pattern, because we have the same key levels, a downward trend line and a support line. So this concept also applies for other patterns as well. If you spot a support and resistance level, then it's a rectangle pattern. If you spot two opposite trend lines, it's a pennant. If you found two trend lines that are heading in the same direction, it's a flag pattern. And so, by knowing this key concept, you don't even need to memorize the name of the patterns. It doesn't matter if it's a triangle, a wedge, or a rectangle. At the end of the day, all of them are based on one concept. Price consolidates, forms key levels, then breaks out. So as long as you can find these key levels, the strategy would still work. Now, once you've identified the consolidation pattern, the next step is predicting the direction of the breakout. Will it happen to the upside or the downside? So a common mistake that traders make is that they immediately take a position at the first breakout that they see. For example, here we spotted both a level of support and a level of resistance, meaning we just found a rectangle pattern. Next, we can see that a candle closed slightly above the upper level. Now, traders would look at this and think, oh, the price broke above the level, and so the breakout will surely happen to the upside. Well, this is actually the wrong mindset to have, because a breakout doesn't equal a trend. There's always a possibility of it being a false breakout. That's when the price broke above a key level, only for it to come back down again. So if you took a buy position here, you would actually lose money. And so, how do we avoid these false breakouts? Well, a simple trick that I like to use to avoid false breakouts is by looking for momentum candles at the breakout. A momentum candle could be in a form of a big candle or multiple medium-sized candles. Let me show you an example. So in this chart, we can see that the price is forming lower highs, meaning we can draw a downward trend line above here. And below it, we spotted higher lows, so we draw an upward trend line below here as well. And now, we just formed a pennant pattern. Next, we saw that a big green candle broke above the upper trend line. But if you look closely, notice that the candle opened way at the bottom, and only a small part of it broke out. So for situations like this, we need to have further confirmation by waiting for the next candle to form. If it happens to be another medium-sized green candle, then it counts as a momentum candle. But unfortunately, it was a red candle that formed instead. so we ignore this signal. Next, we saw that a big green candle broke out, but this time, a big part of it broke out, so this counts as a momentum candle. Now, there are three scenarios that could happen after a momentum candle has formed. First, the price continues to trend upwards. Second, the price makes a pullback towards the key level before continuing upwards. And third, the price reverses downwards, and this counts as a false breakout. And so, what should we do? Should we wait for the price to make a pullback before entering? Or should we just enter right now? Well, personally, instead of trying to predict what will happen next, what I like to do is position myself so that I'll always have the edge no matter what happens. And so what I'll do is, I'll enter a buy position at the momentum candle's close and set my stop loss slightly below the key level. So by doing this, I'll still benefit in every scenario. If the first scenario happens and the price continued upwards, I will end up being profitable. If the second scenario happens, where the price pulls back towards the key level before continuing upwards, my stop loss would not be hit and I would still end up profitable. And if the third scenario happens, where unfortunately it's a false breakout, my stop loss will get hit and it will prevent me from losing more money. Now, after entering a buy position and setting up your stop loss, the next step is where to set your profit target. So first, you need to remember that in a breakout setup, prices tend to have larger upsides. So if we're using a fixed profit target of, let's say, 1.5 times your stop loss, we are basically limiting our upside potential. And so to make sure that we benefit if the price were to make a huge movement, what I like to do is use what's called a two-step take profit system. And this is how it works. So the first step is you want to set a fixed profit target at 1.5 times your stop loss. Next, if the price hits the first profit target, instead of closing all of your positions, you only close half of it. Then, you want to move your stop loss to break even. So now, you still have the remaining half of your positions open with the new stop loss in place. Now, moving on to step 2 of the two-step take profit system. So for this next step, you want to apply what's called the chandelier stop indicator. Next, go to settings and change the ATR value by 2. So now, all you need to do is let the remaining half of your trades run until the chandelier stop switches color. Once this happens, you close your remaining position and take profits. Notice that by doing this, we were able to benefit when the price made a huge movement, because half of our positions are still open. If we closed all of our positions at the first profit target, we would have missed this upside potential. And in this example, we can also see that the price went straight up without forming a pullback. This is why I prefer to enter positions right away, because most breakouts actually happen without a pullback. So if you're constantly waiting for a pullback to happen before entering a position, chances are you will miss many profit potential. And now, let's look at the full strategy in action. In this chart, we can see that the price is forming lower highs, meaning we can draw a downward trend line above it. And as we look below, we also spotted a level of support because of these multiple rejections. So we just formed a triangle pattern. Next, a medium-sized green candle just broke above the key level. However, this candle is still too small for a momentum candle, and so we ignore the signal. Then, we can see that a red candle broke below the key level, but again, it's still too small for a momentum candle, and so we ignore this signal once again. Next, you can see multiple red candles that formed after that, so these multiple candles counts as a momentum candle. So we take a short position. Now for your stop loss, you place it slightly above the key level and apply the two-step take profit system. So step 1, place a profit target at 1.5 times your stop loss. Once the price hits, close half of your position, move your stop loss to break even, and continue with step 2. Apply the chandelier stop indicator and change the value to 2. Then, all you have to do is let the remaining trades run until the chandelier stop switches color. Once this happens, you close your position. Now, a common question that people tend to ask is, why do breakouts happen? What's the logic behind it? Well, let me explain. When prices are on a period of consolidation, it means that both buyers and sellers are equally strong. But once a breakout happens, let's say to the downside, all of a sudden, sellers are now stronger. And because sellers are stronger, buyers who bought at the support level are forced to close their position. Because most of the time, a stop loss is placed near a key level. So now, the buyers are getting stopped out, plus sellers keep pushing, so the downside momentum becomes much stronger. Not to mention, breakout traders like us who saw this opportunity also decides to join in. So all these factors combined causes the price to push lower and lower, which causes a breakout pattern to form. So behind every strategy, there's always a psychological reason behind it. Another question that people tend to ask is, which asset should I trade the strategy with? Well, if you think about it, a breakout strategy will work very well with an asset that likes to make sudden huge movement. An example of that would be cryptocurrency. All for today. Thank you so much for watching, and I'll see you in the next video.